Welcome back, traders and investors. We have Michael Pachter on the show today, research analyst at Wedbush Securities. He's going to be talking on some of the stocks that he covers and the latest tech trends. How you doing, Michael?
I'm good, thank you. And the one stock I can't comment on is King because we're in the IPO, so don't ask me any questions about him, please.
Okay, I won't. Okay,
Yeah.
just before we go into some of these individual issues, just a little market sentiment here. I don't know if you were listening earlier on the show, but Dennis thought we might have seen some upside capitulation on Friday with all those buying balances. The S&P cash made a new all-time high and really sold off precipitously from that. Besides from the individual issues that you do follow, just any kind of overall market sentiment yet?
I think the stocks I cover, pretty much every single one is up between 30 and 50% in the last, few months, six months. And one or two have come back in, so those are the ones I like the most. I like the ones that are the cheapest the most. But, it's hard to put new money to work when the stock has moved up 50% or more. I mean, it's kind of scary, I think, for most investors. So this makes sense to me. The sentiment is a little more cautious than it was when the market was 30% cheaper.
Okay, so do you do anything? I mean, besides your price targets, do you leave it up to the individual investors or institutions to take profits, or use any kind of hedging tactics?
It's completely their job. Their primary responsibility is to figure out when to buy and sell stocks, and that's really not our job. Our job is to tell them what's going to happen, and we try to be right. And then they take our guesses about what's going to happen in context and make better informed decisions about what to do with the various stocks that they're looking at. So, no, I don't tell anybody what to do. I figure they're all big boys, and they wouldn't make so much money if they were bad at it. So I figure they've got much better sense about the timing than I.
Okay, so let's look at a couple issues here that you have as an outperform here, starting with the darling, the Zynga here. It's been on quite a run here. According to the information I have here, you have a $7 price target on it. Got up and made a double top over the 575 level, coming back to the $5 level. Looks like it's finding some support here today. That $7 price target, you sticking with that?
Yeah, I know. I just raised my target to 7, actually. As I look at these guys, I see a company that is very much following in kind of Amazon's footsteps. The difference, I think, is that the founder of Amazon ended up being the visionary CEO. The founder of Zynga ended up being a guy who recognized that he was, far more of a startup guy than a mature company guy. So he wisely, I think, stepped aside and brought in professional management. And I think that the guy who's running the company has a Bezos-like vision about how to, dominate a large and growing market. And I'm pretty confident that he'll succeed. So, my bias is that Zynga is just execution away from, from hitting numbers. And if they don't execute, obviously they won't do it. I think you've had some shorts jump in since the stock, rallied from 280 when the new CEO got there in July to over double that. I think that it was kind of overly tempting for the shorts to step in and decide that they know better and that Zynga's in a dying business. I think a lot of investors genuinely believe that nobody's playing these games, and that couldn't be further from the truth. The free-to-play game market has gone from something like $3 billion 3 years ago to over 12 billion and growing, I think, to 16 this year. So a nice big market. Zynga, when I compare them to Amazon, they're hiring the best people they can hire, which is a very Amazon-like thing to do. They are, clearly interested in gaining market share, and instead of trying, as they did under the founder, to be a social games company only, which is only a couple of $1 billion of that $12 billion market, they've decided that they're good at free-to-play. They understand how to bill people, how to get people to spend money within games and free-to-play games that have virtual items for sale. And they're trying to exploit, the 15 genres that they've identified that are in the top 20 across 20 of the top mobile markets. So they're leading mobile. They're going after the games that cut across all mobile markets. They're going to make their games cross-platform, so they work mobile, tablet, and desktop. And they're going to depart from the all social all the time model to generating player versus player games and player versus environment games. So player versus player is things like Clash of Clans, League of Legends. Those are big franchises. Clash of Clans does $1.5 billion a year by itself. League of Legends $650 million a year. The player versus environment is games like Candy Crush that did $1.6 billion last year. So big opportunities, and Zynga wasn't really in those markets. The shorts think that Zynga will fail. I think that scale matters in this market, and I think that somebody who's big and spends enough money on development, has good game makers, spends the right money on marketing, and has a very large and loyal fan base is going to be able to cross-sell the kinds of games that consumers want to a very large base of existing customers. So I'm pretty optimistic that Zynga is going to keep going up. I think 7 is just the start.
Morganomics feels like he's investing in the people and not the product, and what you just stated there, similar along those lines. A lot of confidence in the management. When do you think there's a new product on the horizon?
I know that there are several new products on the horizon. It's not something though that any of us can really make a call on. If consider these guys entertainment companies, and tell me what the product slate for CBS is 5 years out, or
Okay.
product slate for
You got me
Comcast.
there.
Well, and we don't care. We look at Disney as an investment, and I don't cover them, but we say, gosh, they turn theme park rides like Pirates of the Caribbean into multi-billion-dollar franchises. You would never have guessed that, never. And I remember downgrading Marvel, which I used to cover before Disney bought them, because they were going to take the risk of making the movie Iron Man, remember that?
Yep.
With Jon Favreau as director, and his last film had been a film called Zathura. Look it up, it bombed. And they were going to cast Robert Downey, who had just finished rehab. He had been bounced off Ally McBeal for having an addictive problem. And obviously both worked. I mean, Favreau made a great movie and Downey was amazing. But I thought, wow, Marvel they've lost it. So our ability to pick winners and losers when we hear about content, I'm a game guy. And had you shown me Candy Crush, I would have said it's a bad ripoff of Bejeweled. Now I'm on level 500, so I'm personally addicted to it. I get it, but I wouldn't have gotten it just looking at the game. I would have said there's no way this thing will be popular. We can't tell. So even if we know the lineup, we can't tell. What I like with Zynga is that they're gonna try to hit a bunch of singles, and in this 12 billion market growing to 16 billion, a single is a $100 million annual franchise. I think that they have a very high probability of succeeding with 1 or 2 new singles a year. So, and if they get lucky and they hit doubles and they do 200 or 300 million, they're going to double their revenue pretty quickly. So, they just bought a company called Natural Motion that has 2 games and apparently has 2 more coming. Zynga has at least 2 coming, so I think you'll see 4 games in the back half of the year. And they're launching Farmville again on mobile and tablet in the second quarter, in the June quarter. So I think you're going to see, at least 5 games out of them. If they each get to a 100 million run rate, then you're looking at a company that's going to grow revenue by 60 or 70%. If they get to something higher than that, then they can double the revenue. So they're lean enough to generate a lot of profit on that level of revenue growth.
Just quickly, I'm still the kind of guy that looks for a pinball machine when I go into an arcade. But you talk about the revenues that they generate from these individual products, and I mean, obviously the products are free. Is this just the the advertising that they're getting to the site? I mean, what are your metrics for coming up with the estimations of the money that they make from these individual games?
Advertising is the driver for games like Words with Friends. So there's really not a big revenue model in Words with Friends. You have the ability to buy stuff. First of all, you can turn off ads. So very much like Pandora,
Okay.
You can pay money to turn off ads. But the virtual items for sale in Words with Friends are essentially cheats. There's a way to have the game tell you what the best word you can make out of your letters is, and you pay, I don't know, not very much money. Most people don't pay for those things. I think if you really suck at the game, you'd pay for that. If you just have no vocabulary, you guys, since you speak for a living and you write for a living, you probably have pretty good vocabularies. That's the only one Zynga has that's big ad supported. Most games are virtual item sales, so so poker people buy chips, Farmville people buy pigs or lumber to build their silos. Candy Crush people buy essentially they call them boosters. So you buy virtual items in the game. The average Zynga customer that pays money spends $37 a month. The average King customer pays 17. So pretty significant. If you look at League of Legends, there's 27 million daily active users, generating $650 million per year. So that comes out to something like $25 per daily active. But I don't know the number of daily actives that actually spend money. Probably 10 or 15%. So it's more like $20 a month, which sounds right to me.
Okay. I know I see you don't cover it, but do you have any kind of opinion on Hasbro, the Dark Horse gameplay, and also the Neverwinter D&D franchise seems interesting? Can you comment on that or have an
I
opinion
know
or not?
nothing about Hasbro, so I couldn't even tell you, what toys they have, other than I know they make Transformers. So I don't know. I only know that because of the movies. So I couldn't comment on the stock at all. Playing anything in the comic book arena, the Dark Horse guys are comics, and playing anything in kind of the retro, old school games market, which is Dungeons and Dragons. There's nostalgia and there's value there. I don't know what they're doing with them, so I
Okay.
don't know if they're making movies out of them or toys out of them. So honestly, I'm not competent to comment. If you ask me, do I think Dungeons and Dragons would make a good movie franchise? Maybe. Do I think Dark Horse Comics would make good movies and TV shows? Sure. I mean, where do you think The Walking Dead came from? It's exactly that type of comic book, the graphic novel comic books that turned into big movie and TV franchises.
Okay, moving on to GameStop here. I see you had outperform rating on that and a price targeted at $60. That news came out last week about Walmart getting into the used game business, and they whacked the stock off that. It seems to be holding in. What did that shake your opinion at all on the issue or not?
Yeah, if I were to ask you to describe the typical Walmart customer and then describe the typical GameStop customer, my guess is that you would come up with a pimply faced 13 to 24-year-old guy at GameStop, and you come up with a slightly overweight 45-year-old housewife at Walmart. And so the typical GameStop customer buys games for himself, and the typical Walmart customer buys games for others, just maybe for the kid in the household or for the husband. But when's the last time your mom took your stuff and traded it in for credit? I mean, never. I have to say, I used to collect buffalo nickels, and my mom took them on a vacation and threw them off a ship in Jamaica. I had like hundreds of them because she thought they were nickels. That's the last time I ever let my mom see anything I had. But I don't think that the Walmart customer is going to find any games. I don't think that a gamer would be caught dead trading games in at Walmart for food. They're trading games in for games. So I see Walmart as having virtually no impact. They may, in fact, capture 5% of the market because some moms, really will, dig out these games and take them, but the kids probably weren't trading them in the first place. So I think that GameStop will see no impact at all. This is Walmart's third try. They failed the first two. They're going to fail this time. I'm really surprised they're even trying.
Okay. Your neutral on Amazon, you far exceeded your price target of 330 here. So are you just cautious on that with your neutral rating?
Not even 10% above my price target, so
Okay,
your
sorry.
hyperbole is unwarranted. It's not far exceeded my target. Look, I think Amazon is going to make a couple of bucks a share someday. It's going to make less than that when it feels like it, and it feels like it this year. They're doing a lot of ambitious things. I mean, I think that their Amazon Web Services business will continue to grow. They're not making any money on it. Their Amazon Prime business is growing like wildfire. They're not making any money there. They might with the price increase. Bezos has a very deliberate strategy to grow market share in a bunch of different emerging markets. I mean, in apparel and in footwear, which is there's Apple's acquisition, and in diapers and home care and in groceries, and they're going to invest in that stuff until they think they've got enough share, and then they can turn on the leverage. I think it's naive of investors to believe that Amazon is done growing in 2014. So I think it's premature to give them too much credit for generating a ton of profit. I mean, I think that a $360 price suggests that they'll make $15 or $18 someday when they kind of revert to modest growth. And so it's a 20-something multiple on an imaginary earnings number. I don't think these guys are going to sniff $15 or $18 in 2014 or 2015. So I'm neutral because it is my single favorite company as a consumer. I am a Prime member. I spent $4,000 on Amazon last year. I bought Halloween candy on Amazon last year. I totally get it. People are going to buy everything there. But I don't think they're turning on the earnings tap anytime soon. So I think investors who are looking for a return at this level are naive, and I don't think you're going to see anything, dramatic happen on the earnings front.
Okay, another one with a neutral rating. Pandora here. You had your target of 35. Exceeded that, went to 40. Now hanging back at the $34 level. So is this where you think it's hit its target, and you're just kind of on the sidelines here, or is
Yeah. I have 3 sell ratings, so I certainly know how to write say I hate a company when I hate them. My neutrals are truly neutral. I think Pandora in the high 30s is, fully valued, and I think if it goes much above that, it's going to come back in. We value it based on active users, which has kind of ranged from 72 to 75 million in the last 3 quarters. If you see the active user number tick up, I think this company's worth more. They're certainly monetizing their users better. They have the ability to increase the frequency of ad delivery, and they have the ability to increase ad rates by getting a higher mix of local ads. So I think that they're doing everything right. It's just hard to slap a value of more than $100 or so on each user. Because if you think about the frequency of ad delivery, how many minutes people listen to for the year, it's really hard to get much higher than $100 lifetime value for the user. I think in 4 or 5 years they might be higher because I could see them increasing the mix to more like 80% local, so ad rates will go up by threefold, and I could see them increasing the frequency to 3 minutes from 2 minutes, so you get another big lift in revenue. Everybody's kind of waiting for their content deal to expire at the end of 15, and they have to put something new in place. They just won a deal against ASCAP, the composers, to pay their royalty, and it's very much in line with what Pandora was paying before. I expect the content deal for the record labels and artists to come in line with what they are currently paying, 3% a year higher, something very manageable. And if we have certainty on content costs, then I think you can give them full credit for leverage. That's when I'll probably like the stock as an investment. But in the meantime, there's a ton of uncertainty. They don't make any real money. I mean, they're making pennies this year. So it's hard to value them on an earnings basis. People who value companies like this on a revenue basis are just making a guess as to leverage. I think the right thing to do is think about what a user is really worth to them and what the lifetime value is. And as I said, $100 kind of implies they'll ultimately make $10 in profit per user. And that's going to take a while to make $10 in profit on 75 million users. To make $750 million in profit when their revenues are only going to be around $900 million this year. They're not going to do that this year or next.
Okay, couple of retailers that you have underperform ratings on. The first one, Dennis, has been trying to pick a bottom in, hoping for a short squeeze in Radio Shack. I see you have a price target of $1 in it. Been holding the $2 level for a long time, back up at $2.26. They had a good Super Bowl commercial, but that's about it.
Yeah, I invite you to ask anybody you know if they saw the Super Bowl ad, and when a friend of yours says yes, ask them if they've been in a Radio Shack since they saw the ad. And you're gonna bat zero. You're gonna find nobody who saw the ad who then was intrigued enough to go to Radio Shack. I think the floor on the stock is zero. I have a dollar price target because if the management is prudent, and their creditors certainly are, they'll probably figure out a way to liquidate the inventory and sell the brand, and they might be able to generate a dollar's worth of profit. They have about 100 million shares, so about $100 million for the brand equity. But I actually think as an operating company, operations are worth zero. I think the thing will be out of business before Christmas. So I don't think they're still around this Christmas. I think the Super Bowl ad, however novel and clever, was a waste of money. I think that they drove brand awareness, but not enough for anybody to go in the store. Zero. So pick a bottom. I think you're going to get your face ripped off.
Well, actually, I was in Radio Shack since the Super Bowl because my wife Lisa bought something and she needed me to return it. So I have been in a Radio Shack, but only to return something.
That's great. You weren't in there because of the ad. You were in there because the product. You didn't like the product. That's great.
Okay. Another retailer you have an underperform rating on and an $18 price target. Best Buy had that gap down. I believe it was on some kind of metric, same store. I don't know if it was same store sales or whatnot, but had the dip, is trying to recover from your underperform rating and $18 price target. You're not anticipating much of a comeback by Best Buy.
Yeah, I think I'm really surprised at how my competitors are valuing the company and how the street is valuing it. The CFO, who is very competent and refreshingly candid, has told everybody to expect operating margin to contract by an average of about 70 basis points each of the first 3 quarters of the year. And she has said that that doesn't include further cost cuts, but it incorporates all the cost cuts they put in place so far. So if you assume a 70 basis point decline in operating profit, you're talking about $300 million in lower free cash flow this year versus last, unless they find more costs to cut. So best case, I think, is they find $300 million more costs to cut. It's not like there's any low-hanging fruit. They've already cut $750 million. So best case is that they do the same cash flow as last year. Last year they printed $1.3 billion in free cash flow, except that $800 million of it was from an asset sale that's non-recurring. So they're going to do $500 million at best this year. My competitor's consensus is $770 million this year. I have no idea where these guys are getting that number. That would presume that Best Buy comps positive 5% this year. No freaking way. Not possible. So if they comp flat, which I don't think is possible either, and their cash flow is flat, and that requires $300 million of further cost cuts, then you're looking at $500 million in free cash flow and 340 million shares. So at a $26 price, you're talking about an $8 billion or bigger company on 500 million in cash flow. I mean, it's literally trading at 17 or 18 times what I think the cash flow is going to be this year. Why would you take a 5% return on Best Buy, which could go away? That's just crazy. You should require at least a 10% return, and so that suggests the stock should be valued in the teens. And frankly, I think that the 500 million free cash flow number is pie in the sky. I'm not sure they'll get the cost cuts, and if they comp negative, then the number is going to be much lower this year and then drop again next year. I could see cash flow declining each year, which means you would pay no more than 5 times, and we're talking single-digit stock. So I don't get it up here. I think if you own it, take your money and run. It doesn't make any sense to me here.
Okay, I've noticed just looking at your eggs here, you've been right on with Activision Blizzard and Electronic Arts EA. Going to this Activision Blizzard $22 price target that just had a nice bump up there, getting close to that price target here. You thinking of perhaps maybe raising your price target on that, or are you sticking with it?
I haven't done it yet, and I probably need to revisit my rating and price target and figure it out. I value Activision at a pretty low multiple. I mean, 15 or 16 times. That's kind of a market multiple, and I think that all the game makers are in a position to warrant a premium to the market. But we've got a lot of catalysts coming up. I probably should look at my target and figure out if a higher multiple is warranted. I haven't done so yet.
Okay, and then the same thing with EA. That now, if I'm looking
Yeah,
here,
EA is going to absolutely crush
ooh,
consensus for
okay,
Q1, which ends in June. The Street, I don't understand the Street models at all, and they just this past week delayed the launch of Titanfall on the Xbox 360 from the end of March to the first week in April. So it moved out of their Q4 ending March quarter and into Q1. That is a shift of literally 100 million or more in revenue. All of us have to do something with our estimates and targets for next year. Next year just got really good, and I think that people have not, or they've just been slow to adjust estimates on EA. So I think EA's got a very near-term catalyst. I think that the stock, is going to surprise for fiscal 15 and for Q1 especially. And so that one, yes, I'm working on my model as we speak.
okay, and just to finish up, I'm just looking at some of these movie and cinema stocks that you cover. Have pulled back pretty good here. You think that's just kind of like just kind of a little bit of a seasonal pattern, or you think there's things are changing structurally in the industry?
No, I actually don't. I think that AMC has sucked up a lot of the capital that used to go to Regal and Cinemark. Carmike's gone from $7 2 years ago to over 30. They've been kind of the big growth play, and so there's just more dollars invested in the sector because AMC went public in January. And I think that AMC just gives investors a third relatively large quality name to invest in, and Carmike gives people a small cap quality name to invest in. And those two stocks, just the appreciation in Carmike and the IPO for AMC, has just sucked some of the capital away from Regal and Cinemark. I don't think Regal and Cinemark have done anything wrong. Yes, it is a seasonally slow time. We don't have giant box office now, but box office is looking very good this year, and especially good next year with Star Wars, and especially good the year after with Avatar. So I think that people who are playing for a cycle should see box office grow the next couple of years, and I think that all these are at a decent entry point.
Oh,
I have buys on AMC and Carmike. I have neutrals on Cinemark and Regal, and price targets above where both of those stocks are because they have pulled back. So I think you can make money in any of them.
okay, Michael, I can't thank you enough for coming on the show again. Michael
Pleasure.
Pachter, yeah, research analyst at Wedbush Securities, and as they're saying in the chat room here, you call a spade a spade. That's not something that you really see on Wall Street that much. Thank you for your careful and detailed analysis, and we'd like to have you back on the show again when it permits for you.
Thank you. All right.
All right,
Talk to you
thanks,
next time.
Michael. Have a good
Bye-bye.
day.